And we will move on the same subject, global high impact risks investment and banking investment, and inviting now Nick Robbins, who is head of Climate Change Center of Excellence at HSBC. And he's heading that Center of Excellence, launched in October 2007, and with a mission to analyze the commercial consequences of climate change for the HSBC Group and its clients. And he's also a member of the UK Government Sustainable Development Panel, etc., etc. He's a fellow of the Royal Society of Arts and an associate member of the Securities and Investment Institute. Nick Robbins, welcome to speak to us. Thank you.
Thank you very much, Margot, and thank you very much to the Global Challenges Foundation for hosting this meeting and inviting me to speak. I have a very high-risk challenge. I have 15 slides in 15 minutes. HSBC stands for the Hong Kong and Shanghai Banking Corporation, but is known internally as How Simple Became Complex. I hope I can reverse the order. What I want to talk is really one aspect of this issue of managing risk. We believe that an accelerated drive to a low-carbon economy is better for global economies, better for development, and better for the financial sector. But in that process, there is going to be some disruptive change. And our task really together is try and minimize the volatility of that change in the financial markets. So I'm going to talk briefly about this. Firstly, the move to a low-carbon economy is going to be capital intensive. We're generally replacing resource use with brain power and technology. More money up front, less operating costs. Better overall, but more capital. The capital markets at the moment are not fully equipped to manage long-term climate risks. I think David Bresch highlighted that. I will touch on one risk in particular, high carbon risk. Markets at the moment are not pricing the prospect that fossil fuel assets, which are currently valued, may well be stranded and unused, and the commercial implications of that. I'll also talk about opportunities, and again how markets are starting to think about how we mobilise the global bond market, the largest asset class for low carbon development. And then I'll suggest at the end 7 ideas about how we move financial frameworks and investor practice so that it becomes fit for purpose for this. And the key is actually how we make this routine, a daily activity, make this a reliable flow of finance and rewarding for the financial markets. So first, a very, very busy slide for you, but really this is the $225 trillion question. Paul Dickinson earlier suggested about 70 or 80 trillion dollars are now asking the climate question through the CDP. But our challenge really as a global community is think about how we move the $225 trillion in terms of capital stocks, whether that's in stock markets or bonds or loans or whatever, so that it is aligned with the goals of low carbon economy and climate resilience. Particularly we need to think about this in the context of emerging markets so that their growth aspirations are ensured and development takes place. In terms of how we look at this, there is, I think, a lot of growing interest in how a number of these issues are converging, energy security, climate security, food security and water, and how these move together as a nexus. And I think it's not just one factor which is driving low carbon resilient development, but a whole series of factors leading to system change. In terms of this issue of capital intensity, our view is that capital investment will need to increase, particularly for low carbon investment, whether that's energy efficiency or low carbon energy supply, rising to about $1.5 trillion a year by 2020. As I said, this is investment, not cost. This will then reduce operating costs as we go forward, net benefit to consumers, net benefit to businesses. But also this will be disruptive. We're living through one of the most disruptive technological phases through the digital economy. The digital economy is leading us to be much better off, much better off. But we know in that process this can be very, very disruptive. If we think of Kodak, a great company, but think about how that company and film cameras and so on got left behind as this digital process has moved on. As we move into the low carbon economy, we will be better off, but there will be disruption along the way, and the task for us is to minimize that disruption as much as possible. When we normally think about climate policy, we think about the policies on the right-hand side of this chart, about the policies in the real economy, energy regulation, transport regulation, agricultural regulation, regulation around infrastructure, very important. We need governments to do their job to actually put in place the policies that drive low carbon resilient development. We've been less good about thinking about the financial economy. How does climate factors get integrated into banking regulation, investment regulation, public finance, and also subsidies that we have in many parts of the world for saving as investment. At the moment, we really are in kindergarten when we think about how we integrate climate risk into that financial economy. Excuse me. I just want to give you one example. One concern that has been rising as we think about low carbon infrastructure is about how financial regulation impacts on this. One concern that has been raised, and these are conclusions from a report from the Institut pour Développement Durable et Relations Internationales in Paris, the International Sustainable Development Institute, looking at the potential implications of post-crisis financial regulation on the flow of low-carbon infrastructure. Post-crisis financial regulation, absolutely essential, as we know. But there is a concern that particularly models such as Basel III could cut the capacity of banks to provide long-term credit, reducing the supply and maybe increasing the cost of capital. And this is clearly important, as I said earlier, that low-carbon investments are capital-intensive. There's within the European Union, as many of you will be aware, there's also similar rules on insurance assets to be safe, to encourage greater buffers against financial crisis. But as the report concludes, these regulations are simply incoherent with the policy objectives of mobilising investors for long-term low-carbon capital. So we need to think about, when we are designing policies to ensure financial stability, that we're also not putting in place unintended barriers to the deployment of capital for low-carbon development. So some measures are suggested there in terms of actually, again, how we can mobilise the bond market. But there's another systemic risk that we need to think about. This is not the font is not coming out particularly well. But one of the issues that I mentioned at the beginning was this issue of stranded assets. If we take the notion of carbon budgets, which have been developed by a number of scientists, Malte Meinshausen and so on, we have a limited amount of carbon that can be put in the atmosphere without going beyond our 2-degree target. This has been picked up by the International Energy Agency, and their assessment is really, if we are going to meet our 2-degree goal with a 50% probability, which as we know is a very high risk, flip of the coin probability, more than 2/3 of current proven fossil fuel reserves cannot be commercialised by 2050 without the deployment of carbon capture and storage. That is a profound and disruptive change for the energy system in the coming decades. What does this mean in terms of the outlook for the fossil fuel sectors? Again, this is analysis from the International Energy Agency, a very conservative intergovernmental body. These show the growth rates in terms of gas, oil and coal, again in the low carbon scenario, their 450 ppm scenario. So you can see on the right hand side, gas continues to grow. It's a lower carbon fossil fuel, as you know, but oil and coal start falling year on year, and oil and coal potentially by 3% a year, coal demand 3% a year in the 2020s. That is a fairly substantial shift in the global energy system. Our job at HSBC and our Climate Centre is then to see what could these shifts mean for investors. And I'll give you 2 examples. The first of them was looking at coal, the most high carbon asset. And what we did here was really try and develop a scenario. If coal growth ceases, the growth in coal demand, so not coal use, but just the growth in coal demand, if that ceases in 2020, what does that mean for the valuation of coal assets on the London Stock Exchange today? And the chart on the right-hand side gives you that analysis. So again, if global coal demand peaks in 2020, as the IEA is saying it needs to, what would that mean for the valuation of coal assets today? The answer is they would fall by 44%. So that hits the materiality test for investors. This is material for investors. We need to move to a low carbon economy, But if we don't take account of these risks now, we could be left with shocks to valuations and therefore pension funds and so on. The second is then looking at oil and gas, and again we've developed a scenario to look at actually potentially some of the implications of this. We took a very tough scenario, a $50 per barrel ceiling test. In a low carbon scenario, as we know, there'll be lower demand, higher efficiency. What would be the implications for European oil and gas companies? In terms of proven and probable volumes, the impacts of volumes which could not be developed, about up to 25%. But the overall impact, including price impacts, again, 40 to 60% of current share prices of large European oil and gas companies. Again, a material issue for investors. Why is this relevant? We know that long lead times oil, gas and mining projects, what happens post-2020 is relevant today. We have near-term capital allocation decisions. We know there are a number of catalysts around the world. We have rising concern about air pollution, water stress in emerging economies, India and China notably. We have tightening carbon constraints. We have the substitution of other technologies. And we have peak demand for energy in industrialized countries. How could investors respond? Focus on lower cost, lower carbon assets, and demonstrate what we are calling capital stewardship, stress testing the capital expenditure plans of companies to ensure that they're delivering attractive returns in a 2-degree world. I'd just like to turn briefly to a good news story, the low carbon opportunity. As I suggested earlier, the bond market is the largest pool of assets we have in the world, around $100 trillion. How can that be aligned with this shift to a low carbon economy? We've been working with the Climate Bonds Initiative, and this year we've highlighted that the issuance of bonds linked to climate themes has grown by 25%. The largest area is still in transport and rail, low carbon transport, but growing allocations to renewables and also green bonds by the big international development banks. And here is a good Swedish success story because SEB Bank is the leading bank in this green bond market. Interestingly, in terms of actually where these bonds are, in terms of the country, China is the largest, largely because of its large allocation of bonds to railway, but also growing renewable investment. Very interesting in their new latest policy about driving the low carbon economy, they've been highlighting the issuance of bonds for energy saving and environmental protection. So if I may conclude, 7 ideas really for the next decade, how we actually align capital markets with a 2-degree world. 4 themes for financial frameworks and 3 for financial practices. Firstly, how can we ensure that the core regulatory frameworks on banking, on investment and other frameworks, how do we ensure they include climate and environmental security? Secondly, on financial stability, we need to make sure that we're integrating climate tail risk, as we've heard this morning, in terms of carbon and climate, into the management of market resilience. Thirdly, how do we link the tax incentives, which in many countries we receive for savings and pensions, again with climate and environmental security? And fourthly, how do we use wisely scarce public finance to shift the risk-reward ratio for investors, particularly, as I said, credit enhancing for bonds? 3 financial practices, and then I'll close. Again, for investors to make a core part of their risk analysis, ensuring that the capital they're entrusting to high carbon assets is consistent with delivering returns in a 2-degree world. Second, making routine disclosure by financial institutions, not just of the emissions from their own facilities, but also in terms of the investments they're making. And thirdly, again, for financial institutions to put in place targets so that they are aligned with this global goal of peaking carbon emissions by 2020. Thank you very much.
Thank you very much. Another very interesting and well-structured intervention, and very, very interesting to see, for example, your point on financial regulation. Are you saying also that this is today not included in those frameworks? And in the regulation frameworks, or not enough, or not at all?
I think there's growing awareness, certainly, and certainly within the European Union there's a very useful process going on around long-term financing, and I think certainly within the insurance regulation in terms of the solvency rule, I think there is a recognition that actually the rules are going to be deterring insurance as investors from doing actually what we need to do from a low carbon point of view. So it's growing awareness as yet. And I think that is, in a sense, a start. We need to think about a start of a process. So how do we make the incorporation of climate and environment risk a routine part of financial regulation? Yeah, so it just happens routinely, which is not happening at the moment.
So this is your to-do list.
That's well, not just for me. No,
no, it's not for you, but your proposal for a to-do
others
list.
can yeah, that's right. That's right.
Any questions to Nick? Yes, we have a question there.
Thank you. Peter Holmgren, heading up the Center for International Forestry Research in Indonesia. A very big part of the problem, and potentially a very big part of the solutions, lies in the land-based sectors: agriculture, forestry, livestock, food-related businesses, etc. And very clearly, access to fair, affordable, long-term capital is a major limiting factor in this area. So my question is really, what is the talk, what is the interest from your end of the stick to scale up large-scale finance for small producers, being a big part of the solutions to the challenges we are facing?
No, very good point. I mean, in terms of the work that is being done, I think within capital markets, most of the focus so far has been on energy systems, on power generation, transport, and buildings and so on. People recognise the importance of soils and forests, but again, in terms of capital markets, actually the focus on that has been relatively limited by comparison with energy. And it's one area I'm certain we're trying to encourage within our bank, is recognising agriculture part of this thing. But it hasn't got the attention it's deserved to date, my view would be.
Other questions? One more there.
Hello, Magnus M. from WWF Sweden. Both the financial markets and, as we heard previously, science is very much talk about risk, but perhaps in a bit different way, looking at risk. To what extent would you say, as a representative from the financial sector, these risks presented by science are sort of directly applicable and useful for you in the financial sector, or where might there be gaps to overcome?
Yeah, no, it's a very good question. I think this language of risk is very important. I mean, we know through the recent financial crisis that financial markets aren't always very good at managing risk, and particularly we've had a tendency to look at short periods of historical data and extrapolate forward. And clearly with climate, that is not a very sensible thing to do, because the system is changing. One thing we really need to overcome, I think, when we're translating climate science into financial risk, is much of the risk that is managed in financial markets is relative risk. The relative risk of your investment fund going up or down compared to the market. Not fundamental risk is that actually you could be suffering fundamental loss of value because of climate change. So I think there needs to be a translation exercise. How do we actually both manage that relative risk, but also incorporate the fundamental risks in the way that actually large pools of capital are deployed?
Actually, last night we discussed during a meal together, we discussed the fact that there is this mismatch between the need for long-term thinking to solve our big global problems and challenges, and the fact that our current societal structures and systems for decision-making and economic management is very, very short-term. And it goes in that direction, including for communication. We have less and less patience, and we feel that we have less and less time. But how do you reconcile this? How do you bridge over? And I guess that is also the challenge for the banking sector, of course, to make sure that you can start to think long term. And how do we introduce that? I mean, very often you would like to have a profit immediately, or the short-term thinking. Do you feel that there is is this at all part of your...
I think, I mean, if we think back over the last 10, 15 years, we've had two major financial crises, certainly in the industrialized world and globally. We've had the dot-com equity market crisis, and we've had the credit crisis as well. And I think that's leading to a very profound awareness among the big asset owners of the world, the big pension funds, big insurance funds, sovereign wealth funds as well, that we actually do need to move towards a system that delivers long-term value. Within that, we can incorporate climate risk, environmental risks, and other social issues. So I think we are fortunate to this extent that there is greater awareness of that need to move to a long-term model. And that is good, I think. It provides a very fertile ground for incorporating climate risk. With those comforting words, we thank you very much. And we give another round of applause to wake everybody up. Thank you so much. As you can see, we have tried to pack as much as possible into the program. It doesn't do you good, all of our panelists. We know that you are so competent and you have a lot to say, but we thank you for trying to adapt to our strict rules for speaking and the short time frame that we've given you.